Good morning, everyone. I think most people have joined, so let's start. Very, very welcome to all of you to our first GRAP update from the ASB for 2023. This is a GRAP update specifically aimed at public entities. If you're not from a public entity, not to worry, I'm sure you will still find the content helpful. I am Elisna van der Westhuizen from the Accounting Standards Board, and I'll start us off today. And I'm joined by my two colleagues, Amanda Botha and Nabila Imam Shah. I think we're very happy for all of you to have joined us this morning, and the purpose is really for it to be an interactive session. So we do welcome any comments or questions that you may have as we go through the content. I do just want to share with you a few things that we shared on the chat. Yeah, there's still a lot of people joining. Apologies for the interruption that's causing.
Elisna, I'll let them in. You can go on.
Thank you. So I just want to share with you that there is one or two things that we posted in the chat. Firstly, please note that this session is being recorded and we will make it available on our YouTube channel after today's session. Then we've also shared with you a link in the chat to the slides. So you're welcome to follow the slides on your own, but we'll also share them with you as we go through the presentation. So they'll also be up on the screen for you today. Okay, thank you. I do see a comment about asking for the view to be full screen. Okay, we're actually going to move off of the agenda in just a bit and move on to the slides, but let me do that for you while we're going to have a look at the agenda. Okay, thank you. I do note that there are many people that struggle with load shedding as well, so we'll hopefully be able to keep most of you connected, but we do have the recording that you're welcome to have a look at afterwards should you not be able to join for the full session. So I think with that, let's just quickly have a look at the agenda that we have prepared for today. So we are going to start by having a look at the GRAP reporting landscape for the period 2022 and beyond. So I'll start with that. Then I'm going to hand over to my colleague Nabila, who is going to take you through iGRAP 21, the effect of past decisions about materiality on future financial statements. And she is going to then take us to the break, or up until the break. We'll have a short comfort break thereafter. And then we're going to proceed by sharing with you some information about guidance that we've issued recently that's available on our website. So the purpose is to give you access to resources that you can use to prepare your financial statements. We do have a number of exposure drafts out for comment at the moment, so that will be our next topic. The purpose is not going to be to get your detailed comment on the exposure drafts, but rather we would like to just share information about the exposure drafts with you and share with you how you're able to provide us with your comments. And then we'll end off the session on sort of a lighter note, just sharing with you news from the International Public Sector Accounting Standards Board so that you know what's going on internationally and what you could expect to see coming from us in future from that. So that's the agenda for today, and I'm just going to hand over to my two colleagues, Amanda and Nabila, to each greet you, and then we can start with the agenda. Okay, so on my side, and Amanda, you're up first.
Thank you. I'm not sure, can everybody see me? Yes. Yeah. Morning, everyone, and welcome. I hope you enjoyed today's session. My name is Amanda Botha. Thank you.
Good morning, everyone. Welcome to the GRAP update. This is my very first time presenting in the GRAP update, so I'm really looking forward to it. Thank you.
Wonderful, thank you. Thank you then to everyone, and we hope that you will enjoy today's session with us. I'm just going to stop sharing the agenda, and then we can move on to the slides. So like I said, the slides are available on our website as well. So if you struggle maybe to see what I'm sharing, or if you have any other technical difficulties, you're welcome to just follow them on your own as well. Okay, can I maybe just get a thumbs up if you're able to see the slides? Okay, perfect. So this is just our normal disclaimer that I'm briefly sharing with you the views and opinions that we're expressing in the presentation, or those of us as the individuals. Official positions of the ASB on accounting matters are determined only after extensive due process and deliberation, and that would of course result in pronouncements that the board publish. Okay, we have looked at the agenda already, so I'm not going to spend too much time on this slide. I think we can start then with our first topic of today that I'm going to take you through. So we are going to have a look at the GRAP reporting landscape from 1 April 2022 onwards. So hopefully this will help you to prepare in advance for the changes that are coming in the next reporting period and beyond. I think we have learned from experience that it is important to make entities aware of changes that are coming up in future periods, because you often do need to start thinking about changes that this would require from your entity in terms of information that you need to start gathering or systems that you need to set up. And it's often too late that entities start to think about how they are going to implement new changes. We often find that only within the year, when a change becomes effective, will they start exploring what this means for them. So the purpose of looking so far ahead is really to help you to plan better and be aware of what's coming. I'll also share with you as we go through the presentation some of the resources that's available to help you. Hey, I think most people would have joined, but I see we do still have some colleagues joining. Apologies for the inconvenience. So on this slide, we try to give you a bit of a snapshot of what's becoming effective in the next few years ahead. So I do just want to add that this is based on the information that we have at present, based on the latest Directive 5, which is, of course, published annually by the board in September, and it determines the GRAP reporting framework for the next year. So the latest Directive 5 that's available on our website was approved by the board September 2022, and that is for the period 1 April 2023 and beyond. So that is the document in which you will find what we have there as becoming effective in 2023-24. We do also know of other pronouncements that are becoming effective in future periods based on ministerial approvals that we have already. For example, the GRAP 104. So I think the first bit of good news probably for you is that the 2022-23 period would not result in major changes to the reporting framework. The reporting framework is largely unchanged from the year before. So most of what you applied last year, you would still be able to apply the same way this year without any changes that you need to think about for this year. The pronouncement that Nabila is going to talk to you about next, the iGRAP 21, is a document that the board has encouraged entities to apply earlier, even though that only becomes effective 1 April 2023. So I would encourage you to have a good listen to the presentation she's going to give, and see how you can apply that from this year already. I think you'll see the benefits of it when she goes through the presentation and how it can help you. So with iGRAP 21, then there is a long list of pronouncements that become effective on 1 April 2023, as you see there on the slide. We'll look at them a bit more in the next slide. We, just as a snapshot, have GRAP 25 on employee benefits becoming effective, and alongside that, it's iGRAP 7. Then iGRAP 21 I mentioned. We have amendments to GRAP 1, so you'll see during the course of today that there are actually 2 sets of changes to to GRAP 1 that we have in the pipeline. So just make sure to understand which set of changes becomes effective when. Then we have improvements to the standards of GRAP from the 2020 project that become effective 1 April 2023 as well. And lastly, we have the guideline on landfill sites that become effective 1 April 2023. I do just want to double check. I see some comment on the chat that not everyone is able to hear me. Okay, some others have confirmed that they can hear me, so I suspect it may be isolated issues that exist, maybe with load shedding and connectivity. Okay, thank you for the thumbs up. So apologies to those that struggle at the moment. Maybe just a reminder again that we would have this recording available for your viewing afterwards, if you struggle to hear parts of the session today. Okay, so we've spoken just briefly about 1 April 2023. 1 April 2024, there is nothing known at present, but we do have some changes to some of the standards that the board approved, where the effective date is pending from the Minister of Finance. So we have made changes to GRAP 103 on heritage assets as a result of the post-implementation review on GRAP 103 that we had done. We have proposed 1 April 2024 as the effective date there, and waiting approval from the minister. And I spoke to you about the 2 sets of changes to GRAP 1. So the second set of changes to GRAP 1 relating to going concern, that may also be 1 April 2024, depending on when the Minister of Finance determines the effective date. Then we already know for 1 April 2025 that GRAP 104 on financial instruments, the revised version in 2019, becomes effective on 1 April 2025. So as you can see, there is quite a bit happening in the longer term if we look at the next 5 years, although for this year still the reporting framework is mostly unchanged. So let's now look at a bit more detail on each of the pronouncements that become effective in future, and what it would mean for first-time adoption and then the effective date of them. So let's start firstly with the amendment to GRAP 1 on the presentation of financial statements that become effective 1 April 2023. So this set of changes to GRAP 1 stemmed from the project that we did to develop the materiality guideline. It is linked to materiality, and alongside the materiality project, we looked at changes the International Accounting Standards Board made to their standard on presentation of financial statements that deal with materiality-related matters. So one of the things that exists at the moment in GRAP 1 is that you will often find the presentation for each statement to list a number of items that you should specifically include in each of the statements. So it would typically read something like, as a minimum, your statement of financial performance should include the following items, and then a list of items follows. What this change or these changes are doing is to move away from that sort of checklist approach that exists in the standard at the moment, to introduce just subtly a principle rather that would allow you or more clearly explain to you that you do apply materiality when you assess what items you're going to present in your financial statements. So even though GRAP 1 would include items that you would typically present in your statement of financial performance and position, etc., you still make that assessment of what you need to provide based on materiality. So those changes would become effective 1 April 2023. The next pronouncement, IGRAP 21, I'm not going to say too much about. Nabila is going to take you through all of that. I think, like I mentioned earlier, adoption is encouraged here, and I think you'll see the benefits of it when she goes through the presentation. Then the next pronouncement that becomes effective 2023, the improvements to the standards of GRAP. So the way in which improvements work, if you're unfamiliar with that type of project, is that we make minor amendments to various different standards of GRAP within the one project. And it's minor, non-urgent changes. So we go through this process once every 3 years to update the standards for what we call improvements. So what you will see in this document is various different standards that have minor amendments to them, and you may early adopt these amendments per standard. So you could decide to early adopt the improvements for GRAP 17, but not for GRAP 19 as an example. So alongside the improvements, the guideline on accounting for landfill sites become effective. I'm not sure how many public entities would be affected by this. But should you apply the guideline, just to note that it becomes effective with the improvements, but particularly the improvement to GRAP 17 on property, plant and equipment. So if you do decide to apply the guideline earlier, you should apply it alongside the improvement to GRAP 17. Those two are married and they go hand in hand. Then the next pronouncement is GRAP 25 on employee benefits, and with that IGRAP 7. So we have made changes to GRAP 25 to align it to the latest international standards. The ASB updated the private sector standard a number of years ago, and more recently, the IPSASB updated their standard on employee benefits. It does change, especially the presentation of information related to defined benefit plans quite significantly. So if you do provide post-employment defined benefit plans, then you definitely need to make sure that you understand the changes. There isn't much change to the way in which these benefits are measured, and the methodology around that is more or less unchanged. It's more around the presentation of items. So the grouping of items in your statement of financial performance will look different, and certain amounts are presented on the net basis now instead of the gross basis as before. So that becomes effective 1 April 2023. You may early adopt it, but you are not allowed to adopt it early piecemeal. So you must then early adopt the entire standard if you choose to apply it earlier. Okay. Then the next change is related to GRAP 103 on heritage assets. So I think I've mentioned to you already the post-implementation review that we had done, and as an outcome of that, the board made a number of changes to GRAP 103 that was exposed for comment. The board assessed those comments and approved the changes as final, and therefore the document is available on our website. The Minister of Finance must determine the effective date. That is the next step in the process, and we're waiting for that. So you may not early adopt this or these changes to GRAP 103 because the Minister of Finance must still determine the effective date. So at this stage, it's mostly for you to be aware of. You can look at the changes and start thinking about them and the impact that they may have for you, but they were mostly as a result of the post-implementation review with the aim of clarifying and improving the guidance that we have in GRAP 103. The next set of changes related to GRAP 1 is relating to the project that we did on going concern, and we have, as a result of that project, clarified what the principle of going concern means in the public sector, and we have, alongside that, enhanced some of the disclosures that are being made in financial statements, specifically around the judgment that you apply to assess whether you're a going concern or not, and where there are significant uncertainties or material uncertainties that may cause significant doubt upon your ability to continue as a going concern. More disclosure is now required around those significant uncertainties and management's plans to address them. So we'll talk about other guidance that we've published alongside this, these changes to GRAP 1, fact sheets, for example. So we'll get to that in the presentation a bit later on. I think for now to note is it's in a similar phase of the change as GRAP 103. So we're waiting for the Minister of Finance to give us the approval of the effective date. So in the interim, you may not early adopt these changes. The effective date first needs to be gazetted. The changes are however available, and the fact sheets as well. Then the last set of changes that has been approved by the board relates to GRAP 104 on financial instruments. Sort of similar to GRAP 25, we have revised GRAP 104 so that it aligns with the latest international standards. To GRAP 104, there is significant change, and therefore we do have quite a bit going on to support entities in understanding what the changes are and getting ready to implement them. Even though the effective date is only 1 April 2025, there is a reason why the effective date has been delayed for so long, and that is so that entities have enough time to prepare and get ready to implement at that date. So I think the changes do address some shortcomings that existed in the standard before. It changes the classification of items, specifically financial assets, maybe slight change for financial liabilities as well. And then the measurement of financial instruments, I think, is probably where the biggest change lie in the impairment model. And then because the classification of items may change, if you're now in a different category, then the measurement would also change. So it's again similar to GRAP 25 in terms of the adoption arrangements, that you are not allowed to early adopt these changes piecemeal. Either you early adopt the entire standard, or you wait for the effective date and apply the standard at that point only. I think just to mention, in addition to resources that we have available on our website, such as fact sheets and frequently asked questions, we also have a GRAP 104 reference group that works through the standards piece by piece and trying to anticipate what the practical issues could be with the standard. And as an outcome of the group's discussions, we develop guidance that is within our domain, or we ask the Treasury to help develop guidance from their side. So as the ASB, we, of course, in Directive 5 include the GRAP reporting framework for each particular reporting period. And alongside that, where the standards of GRAP may not deal with a specific type of transaction or event, mostly because those transactions are not prevalent in the public sector, we do also in Directive 5 include international pronouncements that you could consider as part of the GRAP reporting framework. So those pronouncements you are not allowed to adopt. You would just, as part of your GRAP reporting framework, use those international pronouncements to develop an accounting policy that fits within your GRAP framework. We have since or recently started to communicate more clearly to entities what this means. So we do have a frequently asked question that explains that you look to those international standards should there not be guidance within the standards of GRAP, but only those that are specified within Directive 5. If we have not specified an international pronouncement in Directive 5, it means that you cannot use it to develop an accounting policy as part of the GRAP reporting framework. And we have went a step further as well to specify which international pronouncements you specifically should not consider. So we have communication that's published on our website alongside Directive 5 that specifies this. And I think in the FAQ, we also list the pronouncements. So for today's discussion, I've included the list for you on the slide and we can quickly run through them. So firstly, fair value measurement, IFRS 13. Sorry, maybe there's one more thing I should mention before we look at the list, and that is that we as the Accounting Standards Board develop standards of GRAP based on the international public sector accounting standards. Our board has a policy that it applies to see when it's appropriate to do that, but that is usually our starting point. So therefore, we usually wait for the ASB to complete their process of looking at IFRS standards and adapting the IFRS standards for the public sector. Once they've done that, we will ask our stakeholders if we should commence a project locally to then make those same changes to the standards of GRAP or develop a new pronouncement if it's something new. So therefore, entities locally should not apply IFRS standards that are in the process of there are projects underway for them already. So if we look at the first one, IFRS 13 on fair value measurement, the ASB is almost nearing the end now of their project on measurement. So they have made changes to their conceptual framework already, which has been approved at the December ASB meeting. And they are expecting to approve the IPSAS on measurement, which will be aligned to IFRS 13 at the March meeting. In the IPSAS on measurement, they do plan to go a little bit further and provide guidance on other measurement bases as well, not just on fair value like IFRS 13 does. We have asked our stakeholders as part of our work program consultation for 2024 to 2026 if this is something we should look at locally, and there was support for that. So we are going to wait for them to complete their process and then pick that up as a project in our next work program. IFRS 14 on regulatory deferral accounts. So you may think that this has some public sector application. Yeah, we are keeping an eye on that and we will communicate with our stakeholders locally if there's anything that they need to consider, but at the moment not. Then revenue from contracts with customers, IFRS 15. The ASB did publish an exposure draft on proposed changes to measurement for the public sector. The one that was aligned to IFRS 15 was ED 70. They are working through all the comment that they had received. They think that they have now mostly addressed the comment that stakeholders gave them, and as a result, they actually came up with a different model now for revenue. We are waiting to see what is going to happen there. They may re-expose the proposals that they have come up with to respond to comment they had received on the ED. They will probably do that at the March meeting. Because of this potential re-exposure of the principles for revenue, it's unlikely that we can undertake this as a project in our next work program. So likely only after 2026 will we look at that. We will, if we do have resources available in our next work program, maybe just do a little bit of research to see, based on what they end up with, what the impact of those international guidance could be on our local environment. But if we have resources and we do something, it would likely just be a bit of research so long. Then IFRS 16 on leases, the IPSASB did issue IPSAS 43 on leases. I think it is effective 2025. And IPSAS 43 converges with IFRS 16, so that standard is available internationally. We asked our stakeholders whether we should start a project to update our GRAP 13 to align with IFRS 16, but they asked us to wait for the IPSASB to complete their leases project. They are busy with the second phase at the moment, which is the part that's actually important for us in the public sector. They are looking at public sector specific lease arrangements and proposing some amendments to IPSAS 43 to incorporate that as part of the second phase, and to the revenue standard as well. There are some changes proposed to revenue as a result. So Amanda is going to speak to you about the second phase in the presentation, where we talk to you about the EDs, because we have an exposure draft out for comment at the moment, ED 203, that links with this project on leases of the IPSASB. Then lastly, insurance, IFRS 17. We do not have an equivalent standard locally, and neither does the IPSASB. We are just keeping an eye out on the application of insurance accounting to the public sector, very limited application, only really a handful of entities that applied IFRS 4. And we'll see when it's necessary to include IFRS 17 in our Directive 5 instead of IFRS 4. Okay, then the next slide is to give you similar information about IPSAS standards that you should not apply, because we do have projects underway locally for these IPSAS standards that have recently been issued. So I think firstly, employee benefits, IPSAS 39. We have spoken about GRAP 25, that's been updated, and the changes that become effective 1 April 2023. So do not apply IPSAS 39 and wait for our standard, or early adopt our standard. Just to mention that if you look at our website at the page that deals with standards of GRAP, then you'll see that there's a place for approved and effective standards and a different place for approved, not yet effective standards. So you would find the updated GRAP 25 as well as the updated GRAP 24 that are not yet effective on that place in our website. I think GRAP 103 revised is also there now. So the next one then is IPSAS 41. So similar story, that we have revised GRAP 104. We've spoken about that, and we are doing a lot to support entities to get ready for adopting the changes in 2025. Do not apply IPSAS 41. Then the next project is IPSAS 40 on public sector combinations, that's been published by the IPSASB. We do have a project underway locally where we are comparing our standards that were issued pre-IPSAS 40. So we have issued 105, 106, and 107 on transfers of functions and mergers. So Amanda is working on that project where we are comparing our standards to IPSAS 40, and we'll likely expose changes to our standards the end of the first quarter this year, or towards the middle of this year. And what we're mostly doing is to just add guidance to our standards that exist, so that the guidance that was in IPSAS 40 that we thought would be useful for you, we are proposing to add. Social benefits, IPSAS 42 becomes effective this year in January, actually, but we are busy with our project to develop our standard of GRAP on social benefits, so do not apply IPSAS 40. Then amendments to GRAP, IPSAS 19 for collective and individual services. This is part of the IPSAS-B's broader non-exchange expense project. So again, don't apply those changes to IPSAS 19. We will look at this as a next phase after our social benefits project has been completed. The collective and individual services deal with in-kind goods and services that are being distributed, which links with our social benefits, but we are waiting for them to finalize their transfer expenses project. There are other recently issued IPSAS standards which are not yet effective that you should also not consider, but we'll look at them when we look at the last presentation on the IPSAS-B's environment. Okay, then I just want to share with you an overview of current projects as a last slide of this presentation. So we have the project that I spoke to you about, the comparison of IPSAS 40 to GRAP 105, 6, and 7, and we are busy developing those exposure drafts. So yeah, they are not exposure drafts yet. We'll talk to you about what's been published as exposure drafts in one of the coming sessions. So likely after March, you will see that being published for comments. Then I spoke to you about the standard on social benefits that we are busy developing. So just some information on the timeline there as well. Probably July 2023, our board would be able to approve that exposure draft, and we should then commence consulting you on that from July onwards. Then we are also busy with the post-implementation review of GRAP 108 on statutory receivables. So I think many of our stakeholders asked the board to do an extensive review of GRAP 108. It has now been effective for a number of years and practice has developed. So it's an opportune time for us to do a post-implementation review. The board had approved the project brief, I think at the December or November meeting last year, which means that we can now start to plan for this project and start our first phase, which is really for us to get an understanding of the issues that could exist in the environment. We just do a bit of work behind the scenes as the first phase of the project so that we can consult you properly on it in the next phase. So that's something you can look out for in the coming year. Thank you. This is the last slide of the presentation that I wanted to share with you. I just want to have a look at the chat and see if there's anything else that's been raised there that I need to address. Okay. Thank you. Thank you to my colleagues. I see that they have responded to your questions. So thank you. That's it from my side, and over to Nabila.
Thanks, Elizna. I just want to confirm before I start if everyone can see the slides.
Yes.
Okay, perfect. Thank you. Okay, thanks everyone for joining today. I want to take you through GRAP 21, and that deals with the effect of past decisions on materiality. Okay, so just a little bit of background on how this interpretation was developed. So you will remember a little while ago when the ASB was in the process of receiving comment on the guideline on the application of materiality to financial statements. This was issued in 2018. And what we found during this project is that respondents commented on past practices in how they applied materiality. So this involved issues where for immaterial items where they had applied an alternative accounting treatment, they had historically kept records where these alternative accounting treatments were applied. And this was a very common view, or it was practiced by many entities. And there was a view that they needed to keep these records to assess if the effect could become material over time. So as a result of all of this discussion, the board then agreed to review GRAP 3 as a separate project to identify if guidance was needed. And then this is how, based on this review, the board agreed to issue this interpretation, which is GRAP 21. Okay, moving on to the problem statement. Yes?
Apologies, I do just see two people have their hands up. Maybe we could just check if they have questions.
Okay, sure. I'm not sure if they can go off mute, Elizabeth. Maybe they'll have to use the chat function.
Okay, I can allow them the microphone, but I see that they have since raised their or lowered their hands.
Okay.
Thank you.
Thank you. Okay, let's go on. Okay, so what is this problem statement? Right, so GRAP 3 on accounting policies, changes in accounting estimates and errors is used to develop accounting policies. Accounting policies in the standards of GRAP should be applied except when the effect of applying them is immaterial. So this is what GRAP 3 states. And when we talk about accounting policies, we're talking about the principles on recognition, measurement, presentation, and disclosure. So these principles need not be applied if the effect of applying them is immaterial. So what does this mean for entities? This means that entities can apply alternative accounting treatments to the recognition and measurement of items. Let's look at some typical examples. Just on these examples, this is what we've identified that entities usually do. So while I'm going through them, in no way are we saying that these alternative accounting treatments are the appropriate accounting treatments. These are just for us to illustrate to you what has been happening out there in practice. I'm sure a lot of it you can relate to and you are already aware of. So looking at the first bullet point, the expensing of immaterial items that meet the definition of an asset. So this could be, for example, low value assets that meet the definition of PPE, but because they are deemed immaterial by the entity, they are then rather expensed as the use of the entity's alternative accounting treatment. The next example is the expensing of transaction costs that are immaterial to the asset. This, for example, we see for transaction costs incurred to originate financial instruments measured at amortized cost. The last example that I just want to touch on is also entities classifying assets differently, even though they meet the definition of certain types of assets. For example, an immaterial heritage asset accounted for as PPE. So this then just helps with the requirements for PPE that are a little less onerous than heritage assets. Okay, so entities applied then alternative accounting treatments in the past, and they were required to keep records of these transactions and items. And like I mentioned before, this was a general and an accepted view that a record of transactions and the tracking of these items needed to be kept because the entity would then need to assess at a future point whether now these immaterial transactions or items are now material. And if they found that, then they would have made retrospective adjustments. Okay, so we've discussed now the problem statement. What I'm going into now is the principles of IGRAP 21, which will just then touch on how to deal with this. Looking at the scope of IGRAP 21. So this deals with the application of materiality for recognition and measurement. And just to note that the materiality and application to presentation and disclosure, this is still dealt with under GRAP 1 on presentation of financial statements. There are two key issues that IGRAP 21 addresses. The first key issue is, do past decisions about materiality affect future reporting periods? So this also ties in with the problem statement about entities where there was an accepted view that they need to now keep track of these immaterial items because sometime in the future they may actually become material. Issue number 2 is applying an alternative accounting treatment an error or a departure from the standards of GRAP? Let's look at these two issues in a bit more detail. So issue number 1 first, do past decisions about materiality affect future reporting periods? Okay, so materiality is assessed during a reporting period and at reporting date. But looking at this, once materiality is assessed, whether it's during a reporting period or at reporting date, and I think specifically looking at during a reporting period, as circumstances change, materiality should continually be assessed to ascertain if it's still at an appropriate amount or value. So decisions about and assessments of materiality are period specific because you are doing this assessment at a specific point in time or during a specific period. No effect on future periods unless errors occurred. So because you're assessing materiality at a certain point or a point in time, then it would be difficult for now to know what's going to happen in the future and try take things into account for future periods. And by this, I do not mean where you have information available in future periods, for example, from your strategic plan or your budgeting, things like that. So where there is information available, then yes, that should be considered in setting materiality levels. But by no way are we saying that by you setting your materiality now, you're going to have to go into a crystal ball looking exercise and know what is going to happen. Do past decisions affect future reporting periods? So to answer this question, retrospective changes are only made when there's a change in accounting policy or an error was made. This is in accordance with GRAP 3. This is what GRAP 3 requires. Changing from an accounting treatment to a GRAP accounting policy is not a change in policy. So this could happen where, for instance, you have now set your materiality and you have items that you actually deem immaterial, and therefore you now follow your alternative accounting treatment. And then afterwards you see, okay, maybe these items are now material. But if at a later stage you do come to that decision, when you had already set your materiality previously, you had used all the information available to you. And it does not mean that later on now, if this item has now become material, that you have actually made an error or you're now in a position where you need to do retrospective adjustments in order to account for this item. So alternative treatments are not errors unless certain circumstances exist. And those certain circumstances could be if you, for instance, when you've set your materiality, you were maybe negligent, or you have really not considered everything in setting that materiality level. Then you could be in a space where you have an error, and that's where retrospective adjustment is needed. So retrospective changes are limited to situations, like I mentioned earlier, when an error is made by an entity in actually assessing materiality. So from all of this, we come to a point, and this is where entities should be in. So entities can have the two policies, or the internal policies, and the policy, they would have a policy, for instance, on alternative accounting treatments. This deals with immaterial items, and then set accounting policies based on standards of GRAP. So these ones have to be in line with GRAP, and they have to follow GRAP, and these are for material items. Okay, so accounting treatments and accounting policies applied based on materiality during the reporting period and at reporting date. So mentioned earlier, you look at your materiality at certain points, and even though you look at it throughout the year, you would need to reassess it at a reporting date. You determine materiality using all relevant facts and circumstances at the date that materiality is assessed. Very importantly is that you apply it consistently to similar items, transactions, and events. So we're not saying here that you would have necessarily one materiality amount or threshold or qualitative factors for all accounts and elements of financial statements. You can have different materiality levels and amounts for different accounts or elements of financial statements. It may actually be more appropriate to have different levels of materiality, because each account has its own special characteristics and its own risks attached to it. So materiality is determined quantitatively and qualitatively. You consider its effect on individual items as well as in aggregate. The assessment considers the effect on both current as well as future reporting periods. And like mentioned earlier, it needs to be based on all the information you have available. So all these considerations in setting materiality, the guideline on the application of materiality to financial statements does give entities a good guide, a good sort of view on how to go about setting materiality levels. And I don't want to discuss this in this presentation, but that guide is quite useful in what entities have to do and the processes they would most likely go through in setting materiality. That guide issued by the ASB isn't authoritative though, but it is highly recommended. Right, so we've just been through a whole lot of theory, and what I want to do just to illustrate issue 1 is go through some examples. Example 1. So here we have a metropolitan municipality, but I mean, it could equally apply to a public entity. So in this example, the municipality A applies materiality to decide which items of computer equipment should be recognized as assets in accordance with the standard of GRAP on property, plant, and equipment, that is GRAP 17. Computer equipment comprises computer peripherals, such as printers, screens, keyboards, and also high-value computer equipment, such as tablets, laptops, and servers. Computer equipment is mainly used for administrative purposes. So here the municipality considers the nature and value of computer equipment, both individually and collectively, in determining materiality. The municipality determines that the effect of not capitalizing computer peripherals in accordance with GRAP 17, even if considered collectively, is likely to have an immaterial effect on the financial statements, both now and in future. So based on this assessment, let's look at what the municipality develops. So the municipality develops criteria, firstly, in identifying what is considered a computer peripheral based on the nature of the item using qualitative materiality. A quantitative materiality threshold is then set, which indicates that computer peripherals with an individual cost of less than 5,000 Rand are deemed immaterial and should be expensed in the year of purchase. A policy indicating that items that are not computer peripherals or items that have an individual cost of more than 5,000 should be capitalized as assets in terms of GRAP 17. Now, analyzing this scenario. In this scenario, the municipality acquires a range of similar items that are classified as computer equipment. So as mentioned earlier, this computer equipment was either high-value computer equipment or computer peripherals. This could result in individual items of computer equipment, such as the computer peripherals, with a value of less than 5,000 Rand being expensed, and individual items of computer equipment with a value of more than 5,000 Rand being capitalized. The alternative accounting treatment or accounting policy is applied consistently to all similar items in the same category of assets. The accounting will, however, depend on the materiality of each individual item. So here, the municipality would have both an accounting policy, which is in line with the requirements of GRAP, and an alternative accounting treatment, and apply these based on materiality. This would be applicable to both the current and subsequent reporting periods. The municipality would need to determine the threshold at a low enough level, and I can't emphasize this enough, because this level needs to be low enough to ensure that the effect of cumulative expensing of individual items in the current and future periods will not have a material effect on financial statements. Okay, so that's the first example. I think I just want to stop there to see if there are any questions. Okay, I do see a question in the chat. Good points made. 2 questions. Consider materiality on PPE. The accounting policy may identify writing off minor assets. The accumulation of these assets may be material soon. In my opinion, this automatically means that the entity must keep inventory of those minor assets, just in case you hit materiality level. What is the point of having such an accounting policy? So yeah, this question raised is exactly what the iGRAP is trying to give guidance on, that when you do set your materiality at a certain level, and now because history may have shown, or past practice has shown, that, you know, at some point these are now becoming material, then I think your materiality levels will probably need to be revisited, and it needs to be set at a low enough level where it's not going to become material in future. And then the next comment, so then in the example used, entities would still be required to keep detailed records of items that were expensed to ensure that materiality threshold was never reached in future. I do think that it would be useful in terms of entities learning how to go about in setting materiality levels. but I actually think in the bulk or the work from this exercise has already been done, because it was this matter that actually came up as a discussion, and while we were looking at our materiality guideline. And so I feel if this exercise, if entities have already been through this exercise, then there would be a lot that they have already learned from, and hopefully then they can move on from that point and set materiality levels at a threshold. Even looking at qualitative factors, at a threshold where the entity wouldn't be in a position where they're going to now have to keep these records because they've set materiality so close to items becoming material so soon that it's going to now affect materiality levels in financial statements. Okay, I see Elisna has her hand raised. Elisna, yes, please.
Thank you, Nabila. I thought I'd just add maybe just one thing to what you've already mentioned, and that's to emphasize that if you have set your materiality levels appropriately, materiality is that period-specific assessment that you make. Therefore, if you do apply your policy within a period, you expense items because you've deemed them to be below that threshold that you've set, then you do not keep record of those items to see if they cumulatively become material over time. Like I think the first question they mentioned, that kind of defeats the whole purpose of having such an accounting policy if you still need to keep all the records. So that's exactly what the IGRAP clarifies, that you do not need to keep record of all of those items. You apply your policy, you expense those items, and they are sort of dealt with. And then Nabila will probably still get to, I think, the instances where maybe you have an error on hand, but let's say you did apply materiality appropriately, you don't go back and you don't keep record. I hope that clarifies.
Thanks, Elisna. Yeah. So looking at the next question with will these alternative treatment needs to be reviewed on an annual basis as evidence to the audit process. So I can't give much guidance on the whole auditing side, but your alternative accounting treatments, right? So you would then obviously look at it whenever you look at reviewing or whenever you assess your materiality at that point, because then you need to consider whether your alternative accounting treatment is still making sense based on your materiality set. And you would then obviously have probably a different alternative treatment, or it may be reviewed at times, especially when circumstances change. From an auditing process, all that I can say is that whatever is done in the assessment of materiality, for entities to please ensure that you've documented everything, that your thought process and the assessment you've done and whatever you've went through in setting materiality, including discussions with those charged with governance, make sure all of those things are documented. If your process and the way you went about in setting your materiality is nicely documented, I think from an audit point, it would make it very easy for auditors to be able to scrutinize that process to determine, or well, whatever auditors are looking at, whatever they want to assess. The next comment, if implementing the alternative accounting for low value assets, does it mean you only need to change the assets policy document only, as you mentioned that it's not a change in accounting policy, and would any disclosure be required? Okay, so very important to know that, just want to take a step back. GRAP 3 requires that accounting policies be set for material items. Right, so where the entity has went through the assessment of materiality and found that they do have immaterial items, GRAP 3 says that the standards of GRAP need not be applied to immaterial items. So whatever the entity does with the immaterial items, that then they're not bound by any GRAP requirements. That is up to their discretion to determine how they want to account for these immaterial items. So the alternative accounting treatment is not a GRAP accounting policy. It's more an entity's internal policy and what they decide as an entity on the treatment of these immaterial items. So just on that, which I will also discuss later in the slides, is that whatever you decide is an alternative accounting treatment still has to make sense. It's probably not going to be, for example, looking at PPE, it's not going to then follow the requirements of GRAP 17. Maybe you'll get guidance from another standard in what your alternative accounting treatment will be. But then again, it's not a requirement of GRAP. It's not that you're following a specific GRAP for your alternative accounting treatment. Entities just need to bear in mind that the alternative accounting treatments do need to make sense in a way that it still satisfies or it's in line and doesn't go against the qualitative characteristics of financial statements in the conceptual framework. And then the last point on would any disclosure be required? The disclosure would not be required from a GRAP perspective, but if an entity feels that providing this disclosure does provide useful information to users, they may disclose how they've determined then materiality and how or what they've used as alternative accounting treatments. Okay, I'm going to go back to the slides. Right, so I'm looking at example 2, and here the nature is different. So the nature of computer equipment. So let's go through this example. So we have 2 examples just to give you an idea of how materiality is considered. So in example 2, College A develops a materiality threshold for the acquisition of computer equipment. Computer equipment comprises computer peripherals such as printers, screens, keyboards, and external cameras and microphones. And B, other computer equipment such as desktop computers, laptop servers, and 3D printers. The college mainly offers IT-related qualifications, and most computer equipment acquired is used by students in its computer labs. Given the volume and use of the computer equipment by students, computer equipment is an integral part of the college's infrastructure and service delivery. The college determines that while the value of individual items of computer equipment, including some computer peripherals, are immaterial, the collective, which is the aggregate value of all computer equipment, is material. As a result, the college decides that all computer equipment should be recognized in accordance with GRAP 17 because of its collective materiality. So this is when they assessed in aggregate. So here we see what is different to example 1 is that the computer equipment is integral to the college IT infrastructure. This makes it qualitatively and collectively material. Okay, so before we go into issue 2, I'm just going to check again if there are any comments. Okay, so we just have a comment for the slides. The link to it was shared earlier. I'm just gonna copy paste it for you. Okay. Right, then let's move on to issue 2. Right. Issue 2 is alternative accounting treatments, errors, or departures. So can accounting treatments be errors or departures? GRAP 3 allows entities to not apply the standards to immaterial items. So as a result, applying an alternative accounting treatment is not a departure, and it's also not an error. Right, I think this also addresses one of the comments that was raised in the chat. So let's look at instances of when errors can actually arise. So errors can arise from immaterial items that are omitted from the financial statements. So I think it's important to understand that for these immaterial items, where you've now developed an alternative accounting treatment, those immaterial items are still getting recorded. They are still shown in the entity's books. Not showing them at all, that this will be an error. Point 2, inappropriate accounting treatment applied because of a failure to use or misuse of reliable information that was available or could reasonably have been expected to be used. So this could be in instances where the entity had information available but didn't use it. They may have been negligent. They were in situations where they had all this information available, but for some reason didn't use it. Right. Point 3, alternative accounting treatment is applied to achieve a particular presentation in financial statements. So this is incorrect. This is actually manipulation. Entities should never be in this position where they're applying now an alternative accounting treatment to show or to achieve a particular presentation in financial statements. An incorrect assessment of materiality is made, resulting in material transactions accounted for as immaterial transactions. Okay, so for all of these are instances where errors can arise, and when you do have an error, then GRAP 3 needs to be applied, and this is where then you have to adjust your financial statements retrospectively. Okay, let's look at some examples. Right, now example 3, and this is using the same facts as in example 1. So this is where we had the municipality where they had computer peripherals, where they identified that any computer peripheral with a value of less than 5,000 Rand, they will expense because they deem that as immaterial, and the expensing of that is the alternative accounting treatment. Okay, so just building on that example, in year 1, the total value of computer peripherals acquired during the year with an individual cost of less than 5,000 Rand amounted to 100,000 Rand and was recognized as an expense. The total value of computer peripherals and other equipment acquired with an individual value of more than 5,000 Rand amounted to 4 million Rand and was recognized as PPE. In year 2, the municipality now establishes a major high-tech call center to respond to service delivery, finance, and other related queries from the public. This results in a significant investment in new computer equipment of all types, which are both computer peripherals and other computer equipment. The establishment of the call center means that the municipality needs to reconsider its assessment of materiality for computer equipment. So given the nature and volume of computer equipment acquired during the year, as well as the expected purchases in subsequent reporting periods, the municipality revises its criteria and materiality threshold to indicate that only certain items of computer equipment with a value of now 3,000 Rand or less can be expensed. The result is that some items that either by nature or value that were considered computer peripherals and expensed in prior years would now be recognized as assets in accordance with GRAP 17. So let's look at this example. Let's do an analysis of it. So here we can see that circumstances changed drastically. So where computer equipment was used by the municipality for strictly administrative purposes, they now have developed a high-tech call center, and they have procured a whole lot more of computer equipment that they're now going to be using more frequently. And the change in these circumstances has also led to them changing their materiality, which makes complete sense. Right, so analysis, based on this fact pattern, there is a change in both the qualitative criteria as well as the quantitative materiality threshold from year 1 to year 2. Materiality is assessed during a reporting period and at reporting date based on facts and circumstances on the date of assessment. The municipality's determination of materiality in year 1 was appropriate based on the information available and activities undertaken at that time. As a result, the municipality will not make any adjustments in year 2 for the computer equipment that was expensed in year 1 as a result of the change in materiality for the same items in year 2, if they were to be acquired under the revised materiality threshold. So here you can see, because circumstances changed, there is no error. There is just now a revised materiality, and then the municipality will continue with its operations using the materiality set at the new level. Okay, before I go on, I just want to see if there are any comments in the chat. Okay, I don't see anything. Let's move on. Okay, first time application of iGRAP 21. So as Elisa mentioned earlier, iGRAP 21 is effective from 1 April 2023. So just to for entities to know how they will transition into iGRAP 21, assessments of materiality are period specific in their required judgment. And so based on this, it really is difficult to assess whether materiality was correctly assessed in the past. The important thing is that in accounting, we shouldn't use hindsight. I mean, if many of us knew in the past what we know today and what the future actually held, then we may have done things differently, but that's not how accounting works. So it's the information that's available at the point, and whatever information is also available in budgets and strategy reports for the future. So based on that, the transitional provisions is that the iGRAP will be applied prospectively, and there is no need to assess past decisions. Okay, I just want to touch on some practical issues to consider, and I think also a lot of the comments in the chat stem from these practical issues. So alternative accounting treatments are not based on accounting policies for specific transactions in standard. So you will remember that I mentioned earlier, if looking at the PPE example, where the alternative accounting treatment is to expense, that expensing does not come from the GRAP 17 standard. And even though your alternative accounting treatment may come from principles in another standard, an entity should always keep in mind that the alternative accounting treatment is not inconsistent with the qualitative characteristics in the conceptual framework. The materiality guideline identifies a process to assess and apply materiality. So the use of the guideline is not authoritative, but it is quite beneficial to guide entities through the process of how to go about in assessing and determining materiality. It's important to document your materiality considerations and discuss with management and oversight structures such as those charged with governance. We cannot emphasize the importance of clearly documenting considerations. Also, entities should consider all available information and consider the effect on future periods. I think we have mentioned a lot of this in a little earlier in the presentation. So just to recap. Okay, so that brings us then to the end of iGRAP 21. I'm going to stop there and see if there are any questions. If there isn't anything, then we are scheduled for a break. Okay, so I don't see any questions in the chat. Thank you, everyone. Elisa, do we have a 15-minute break?
Yes, Nabila, we can break until 1:45 per the agenda. We resume at 1:45, so I think we can do that. Thank you.
Thanks, everyone. See you at 1:45 then.
All right, I hope everyone is back and everyone enjoyed their break. I'm going to continue with sharing some information around the recently issued guidance with all of you. So the first one that I really want to talk about is the work program for 2024 to 2026. So for this one, the board, as it has done in the past, issues an exposure draft to really get respondents' views and stakeholders' comments around what projects should be undertaken within the next 3-year cycle. So for this one, ED 194, taking stock, was issued by the ASB, and the board then considered the comments from the respondents in finalizing its work program for the next 3 years. So first of all, I must say that respondents were generally in support of the ASB's work and the projects that it intends to undertake within the next 3 years. There are various areas that the board has identified, and under each of these areas, there's a number of projects that the board will then undertake commencing 2024. So the first area was around identifying gaps in the ASB's literature. So for this one, the ED noted that the board is currently working on developing guidance on social benefits, and then that the board intends to develop guidance on transfer expenses. So the objective of the transfer expenses exposure draft and the guidance will then really be to provide guidance around the accounting treatment of transfer expenses, but indirectly also provide guidance around the classification of transfer expenses as part of this project. So from the respondents, there were definite support for these two projects. Based on identifying gaps in the ASB's literature, the board then agreed that it's going to continue with the development of guidance on social benefits. And secondly, that we will commence developing guidance on transfer expenses. The respondents also provided feedback on a number of other issues where they thought that guidance might be needed. But for this, the board considered that and agreed that it's not really a standard setting activity, but it could be dealt with through frequently asked questions or then through fact sheets or then through developing non-authoritative guidance that will be included in the relevant standards of GRAP. The next area where the board decided what's as part of the board's work program is convergence with international standards. And in the ED, two proposals for this was made. The first one around the development of a standard on measurement of assets and liabilities in the public sector, which will be based on the IPSA standard that deals with measurement of assets and liabilities in the public sector. And that goes with that is the revision of the conceptual framework to really make sure that the framework is updated with the measurement principles related to assets and liabilities. There was also a discussion in the exposure draft around two other projects. The first one being the revenue project from the IPSAS-B. So on this one, the IPSAS-B is currently still finalizing the comments, and it's likely that the IPSAS-B will then re-expose the standard that's dealing with revenue. The revenue standard is about combining the guidance on revenue with non-exchange transactions and construction contracts into a single exposure draft, and then based on that, or a single standard, and then based on that, providing guidance around when the present obligation is met and when and at what point should the revenue be recognized. But Lesna will inform you a bit more about this later on during our presentation this morning. The next project that the IPSAS-B is also considering is really around the leases project. So again, there was a discussion in the exposure draft around commencing guidance and the development of guidance on the leases project. I will later on tell you where the IPSAS-B is with their project to this extent. But for the next work program period 2024 to 2026, the board has then agreed that we're going to continue with the development of guidance on the measurement of assets and liabilities in the public sector, and along with that, update the conceptual framework to incorporate the measurement principles in the framework. For the leases project, the board agreed not to do any work now, but rather wait for the IPSAS-B to finalize their project. The leases standard will have an effective date internationally from the 1st of January 2025. So as a result, the board would rather wait for entities, for the international, from an international perspective, that entities actually implement the standard to identify the issues. From the revenue project, the board agreed that for the period 2024 to 2026, that we need to identify all the issues that could impact the application of the standard locally, and that we should start identifying those, that when we start and commence with the development of the standard, that those issues are already flashed out there and we know how to deal with the standard going forward. The next area was around the maintenance of the standards of GRAP, and this is really the 3-year improvements project that the board undertakes. Again, we are currently in the process where the board has issued an improvements project. So Nabila will talk about the one that's currently underway. But in every cycle, work program cycle, there is an improvements project really to update the standards with minor non-urgent issues and principles. The next area that was discussed in the exposure draft was really around the promoting of the adoption of the standards of GRAP. And really there was two issues discussed here. The first one was to promote the adoption of accrual accounting for departments. And then secondly, the various directives, to combine the directives and the transitional provisions and to consolidate that into a single document. So on the adoption of accrual accounting by the departments, most entities supported the ASB's proposal to promote the adoption of accrual accounting. They made some suggestions around that the board should communicate exactly what it is doing around promoting the accrual accounting adoption by departments. Then the respondents also supported the consolidation of the directives into a single document. So those will be the two projects that the board undertake as part of promoting the adoption of the standards of GRAP. On the review of the standards, so this is the projects where the board consider post-implementation reviews and desktop reviews. So a post-implementation review is really taking a step back, engaging with preparers and users to understand what challenges they have, first of all, with the implementation of the standard, and from a user's perspective to really understand if the standard is providing all the necessary information that they can use in order to prepare the financial, or to hold entities accountable and to make informed decisions. From a desktop review, the objective is really to have a look at what entities have done in their financial statements and to what extent have they complied with the principles in the standards. Also to understand if there are any emerging issues and if there are any challenges that entities experience with the application of the standard. So on the reviews of the standard for the work program 2024 to 2026, the board has agreed that it's going to do a post-implementation review on GRAP 108 on statutory receivables. So statutory receivables, GRAP 108, became effective on the 1st of April 2019. And really, the idea of the post-implementation is to understand what challenges entities experience and whether the standard provides the necessary information to the users to make informed decisions. On a desktop review, the board agreed that we're going to do a desktop review for GRAP 18. So that's on segment reporting. And really, during the consultation, we've noted that stakeholders are uncertain as to when GRAP 108 should apply, and if they only have one segment as an example, whether the standard is still applicable to them. So we will undertake a desktop review, so looking to what extent entities are complying with the principles in GRAP 18. The board then also agreed to undertake a desktop review on GRAP 20, that's with regards to related party transactions. And this is really because there was divergence noted in practice around what entities see as a related party transaction, and then related to that, the specific disclosure requirements that entity include in their financials. So those are the 3 projects that the board will commence with regards to review of the financial statements. The last issue was really in the exposure draft around emerging issues, and this is where the board asked respondents their views around identifying 3 potential emerging issues. The first one is around climate-related disclosures and sustainability reporting. The second one was to develop more detailed information around compensation of employees. And the last one was then to develop some kind of an information document to explain the various reporting frameworks that's out there and when and by whom entities should apply that. Again, based on the comment and the feedback that we have received from respondents, it was first of all agreed that the board will not now commence any work on climate-related changes and sustainability, but that we rather feed into the IPSAS-B's process, as they has recently commenced work on developing guidance around sustainability reporting. Around the compensation of employees, the board agreed that we first need to have a look at what other jurisdictions are doing and then really understand if there is a need for similar guidance from a local perspective. And on the last one, the reporting frameworks that are applied within the common economy, who apply them, and when are they applied, the board then agreed that we are going to develop an information document around the various reporting frameworks. The last area that the board considered was around the communication from stakeholders, or with stakeholders, pardon me. And for this one, the board then agreed that we need to add a specific project on the work program around enhancing the application of standards of GRAP. So what this really means is to provide guidance in the form of YouTube recordings on either topical accounting issues or then on specific areas within the standards of GRAP, for example, depreciation or on impairment, and then also to provide some guidance on how the financial statements could be used and how the financial statements are useful to entities. So on the work program for 2024, the consultation, like I've said, has been finalized, and the final work program from the board is available on our website. The next area that I want to talk about is the amendments to GRAP 103 on heritage assets. So this was as a result of a post-implementation review that the board undertook. The board then, based on the results of the post-implementation review, agreed to make various amendments to the principles within the standard. These principles was exposed. The board followed its normal due process, obtaining comment from responses, from stakeholders, engaging with them specifically on the proposed changes, and then finalizing the changes, which was done towards the end in June 2022. For the proposed amendments to GRAP 103, the board then still needs to submit. The board, in fact, has actually submitted a proposed effective date to the Minister of Finance. So we are awaiting the approval from the Minister of Finance for these amendments. Keeping in mind that amendments to a standard needs to be available at least 1 year in advance before they become effective, so that entities are aware of them and that they can plan in advance in order to implement the standards. So with regards to the amendments to GRAP 103, I'm just going to highlight quickly on each of the various areas where the amendments were approved by the board. The first one was on the definition of a heritage asset. So for this one, the board had a look at the legislative description of a heritage resource and agreed to better align the definition in GRAP 103 with what we have in legislation. So the concept of cultural significance was brought into GRAP 103, and cultural significance then links directly back to what we have in legislation. Also, as a result of the inclusion of the concept of cultural significance, there's various characteristics that's explained again, and examples included in GRAP 103 to assist entities to assess whether a specific item meets the definition of a heritage asset. And again, all the characteristics, all the examples, and then the definition is aligned with what we have in legislation. But the board agreed that the definition will remain broad enough so that entities can still recognize and account for asset in terms of GRAP 103 as a heritage asset, even though it might not have been designated as such in legislation. The next area where the board made changes was around the classification of heritage assets. So currently GRAP 103 says that if a heritage asset has a significant alternative use, you need to account for that asset in terms of the use, which means then that some of the heritage assets are reflected as part of property, plant and equipment. Now, the amendment that the board made to GRAP 103 was really to do away with that requirement, which means that all heritage assets will now be accounted for using GRAP 103, irrespective of whether that heritage asset has an alternative use. What it also then means is that heritage assets will now no longer be depreciated. If it had been accounted for under property, plant and equipment, then the entity had to depreciate it. But now, because all the assets are accounted for using GRAP 103, there will no longer be any depreciation because GRAP 103 only requires an entity to assess if a heritage asset has been impaired. The next area is the inclusion of additional measurement guidance to assist entities. The first of which is to include guidance around peer group data, really allowing an entity to have a look at peer group data. So having a look at the similar heritage asset held under similar circumstances by another entity to determine a reliable value for the heritage asset. Then also clarifying the guidance around the variability in the range of reasonable fair value estimates. So the guidance now is saying that if the variability is so significant and the probabilities of the various estimates cannot be reasonably assessed, in those circumstances, an entity will not be required to recognize a heritage asset. The next area where the board proposed changes was around protective rights imposed on heritage assets. So for this one, a protective right, first of all, the board clarified that it means that there's any ethical legislation or statutory obligation imposed on a heritage asset. But the board then also clarified that even though there may be a protective right, this should not preclude an entity from determining a reliable value for a heritage asset. For those external protective rights that are imposed on a heritage asset, the board then agreed that we need to provide certain disclosures, specifically around understanding the protective right that's imposed, the period, for example, as well as information on the carrying value over which a protective right has been imposed. The next area where the board made amendments was around the reassessment of a subsequent value. So currently, GRAP 103 requires an entity to assess whether it is able to determine a reliable value for a heritage asset. And in the case that market information is not available and an entity are not able to determine a reliable value, GRAP 103 says that you should not recognize that heritage asset. What is now new in GRAP 103 is that if one of the indicators has been triggered and there's changes in the market, for example, that will actually in fact allow an entity to subsequently determine a value for a heritage asset. And that is what GRAP 103 has now been amended for, to indicate that if an indicator has been triggered and an entity will be able to determine a reliable value, that heritage heritage assets should be valued, and it should be recognized, even though it could not have been recognized on initial recognition. Now, the indicators that's included in GRAP 103 is around changes in the condition of a heritage asset. And this is, for example, where the heritage asset is restored into a usable condition. And based on the fact that it can be used now, there's market information available to determine the value for that heritage asset. Also, information becomes available through the application of new valuation techniques or through the establishment of new markets, and hence the entity is subsequently able to determine a reliable value. The last indicator is that there's changes in the demand for the market or by the market for a specific heritage asset that will enable an entity to determine a reliable value. The second last amendment to GRAP 103 was around heritage assets borrowed from or on loan. So previously this was an encouraged disclosure, but based on the engagement with the users during the post-implementation review, they've actually indicated that information about heritage assets borrowed from or on loan is quite useful. And not all the entities necessarily disclose the information because it was an encouraged disclosure. So the amendment to GRAP 103 was really to make this a mandatory disclosure requirements. So if an entity now has heritage assets that are borrowed from or on loan, that entity needs to provide information around describing the heritage asset, indicating the entity to whom it was borrowed or on loan to, and the period of the arrangement in place. The last amendment that the board made to heritage assets was really to eliminate the other encouraged disclosure requirements within the standard. And this is kind of in line with what the board has done after its first post-implementation review on GRAP 16 and 17. So information about the age and condition of a heritage asset is now no longer included as an encouraged disclosure in the financial statements, as well as disclosure of information about the fair value if an entity applies the cost method of accounting, etc. So like I've indicated for this one, the board has made a submission to the Minister of Finance to determine the effective date for the new requirements. The next amendments that I want to talk about is around GRAP 1, and Ilisna indicated to some extent around the changes are going concern earlier on in her presentation. So GRAP 1 currently requires an entity to prepare financial statements, pardon me, if it is on a going concern, unless there's an intention to liquidate the entity, to cease the operations, or the entity have no realistic alternative but to do so. In those circumstances, the financial statements can now no longer be prepared on a going concern basis. So the amendments that has been made to GRAP 1, and these have been approved by the board in November last year. It's really to clarify that if an entity is, there's a decision taken to liquidate the entity, to cease its operation, or there's no realistic alternative to do so, an entity should not prepare its financial statements on the going concern basis. However, in the case of a transfer of functions, whether it is some of the functions or all of the functions, and in the case of a merger where two or more entities merge, in those instances, it remains appropriate for the entity to prepare its financials on a going concern basis. And the reasoning behind that is really because the entity, the functions that were previously provided by the entity and is now being transferred or that are merged will continue to be provided, even though in another form or by another entity. Then the standard is now also clarifying that an entity needs to consider the guidance in GRAP 105 that provides guidance to both the acquirer and the transferor to provide guidance when it's involved in a transfer of functions under common control. GRAP 106, transfer functions not under common control, and mergers GRAP 107, where again there's guidance included for the combined entity as well as the combining entity. In addition, entities should also consider the guidance in GRAP 100 on discontinued operations when it is involved in a transfer of functions or in a merger, and that impacts its assessment around whether or not it continues to be a going concern. In addition to the guidance that has been clarified, the board then also included specific disclosure requirements. The first one being that management needs to disclose the significant judgments and assumptions that it has applied to conclude that the entity can continue as a going concern, and it is appropriate to prepare the financials on a going concern basis. However, where there are certain uncertainties that may impact the management's assessment of the going concern, specific disclosure requirements are now included in GRAP 1 where there are uncertainties. First of all, the fact that there are uncertainties that may exist, that might cause significant doubt on the entity's ability to continue as a going concern, so making that statement that factually. Then also information about the principal events and circumstances that gave rise to these uncertainties, what the possible effect of these uncertainties might be on the current and then on future reporting periods, and then information on management plans and actions that I want to take in order to mitigate the effect of these uncertainties. So for this one, as with GRAP 103, after the board has approved the amendments, we now need to make a submission to the Minister of Finance to determine the effective date for GRAP 1. Again, as with GRAP 1, any amendments needs to be in public domain at least 1 year before they become effective. In addition to the amendments, there was also 2 fact sheets that the board has issued. One providing guidance to entities in assessing when they are a going concern, and then another one where the entity concludes that it can no longer prepare its financial statements on a going concern, but I will talk about that in just a few minutes. So what's new at the Accounting Standards Board? First of all, the board approved the improvements to the standards of GRAP. There's a post-implementation review on the accounting by principals and agents, and then an IPSAS that has been approved that we are issued concurrently around concessionary leases and the right of use assets in kind. And that will form part of a later discussion this morning. So what are the newly published resources? The first one is the research paper on the desktop review of cash flow statements presented in the financial statements. So a research paper based on a desktop review that we undertook for GRAP 2. And another one is a review report on the presentation of budget information in the financial statements. Again, the results of a review of a desktop review, pardon me, that we have done. We've just changed the terminology from a research paper to a review report. So going forward, any desktop reviews that the board undertakes, we will then issue a review report to basically explain what our findings was, based on the engagement with the stakeholders, what practices were identified, what concerns were noted with the application, and then actions as a result of that. So really, it's quite an interesting document to read because it highlights all the issues that were noted around non-compliance with the specific standard. And that's really the objective of a desktop review, as I've mentioned earlier, to identify the areas of non-compliance within a specific area and a specific standard, and then to also identify practices that are applied. Also to note that when we do a desktop review, we select financial statements on a random basis, and the review will not highlight and point out individual entities where there was non-compliance. The objective is to highlight more of the pervasive issues that we've noted. So on the cash flow statement, what we've noted there, and based on the engagement with the stakeholders, because once we have done the review of the financial statements, we engage with the stakeholders to really understand the reasons for what we've noted around the non-compliance, as well as to identify other practices. So what we've noted from the cash flow statement is really that the principles in GRAP 2 is appropriate, but entities are struggling with the application requirements within the standard. And some of the root causes we've noted is, first of all, that entities don't allow enough time to prepare the cash flow statement. So when it's year-end, the focus is on the income statement, the balance sheet, and the notes, and making sure that everything ties up. But the cash flow statement is one of the statements that is kind of left to the last, and we just quickly complete that before we have to submit the financials to the auditors. Next root cause was really that entities are uncertain as to what items needs to be adjusted in the reconciliation and what items now need to be presented on the face of the cash flow statement. So really boiling down to the application of the principles in the standard. Also, there's much reliance on templates and software programs to make the necessary adjustments without the entity then going back to check whether there are any additional items that has to be adjusted in the reconciliation. And then lastly, a number of entities indicated that there's uncertainties around the nature of the entity's activities and to what extent that impacts the reconciliation and the adjustments that needs to be made in the reconciliation. So as an outcome of the research paper, the board looks at the findings, the root causes, and then makes certain decisions. So for GRAP 2, because the overall observation was that the principles are appropriate, there are no changes to a GRAP 2. There's only a frequently asked question that we have issued around the treatment of consumer deposits and how it needs to be reflected on the cash flow statement. And then in addition to that, we have shared a number of application issues with the National Treasury for their consideration when they update the GRAP accounting guidelines. The next one is the review report on the presentation of budget information in the financial statement. So that is on GRAP 24. And again, we have considered to what extent there is non-compliance with the principles in the standard. So the majority of the entities that were included in the review, the conclusion was that they do comply with the requirements within the standard. Some of the findings that we've noted was really that when the entity prepared the presentation of budget information, they adjust the budget information to align with the actual amounts. But instead, GRAP 24 says that you need to adjust your actual amounts to align with your budget information. So that was one of the areas where we've noted there was issues around presenting the information. Also, the changes between the approved and the final budget were not always explained in the presentation of budget information in that statement. The comparison did not reflect the broad classes and classifications or headings that were used in the approved budget. So again, there was departure from what was presented in the budget, whereas the budget document is actually the document that entities need to compare the actual amount to. Then we've also noted that there's poor quality around the explanations in the notes to the financial statements in the accounting policy, and then in the statement of budget information itself, information that's duplicated, and even in some instances that duplicated information does not agree. So some of the amendments as a result of the standard was that there are going to be amendments, and those are included in the improvements project, which Nabila will talk about in just a while. One of the areas that was also there's uncertainty is around what is publicly available. The requirement in GRAP 24 is that an entity need to present the statement of budget information when it has made its budget publicly available. And for a number of entities, specifically in the public entities environment, they were uncertain as to what exactly is the meaning of publicly available. So when should they actually apply the standard? In addition, there was also a fact sheet that was developed, and I will talk about that in just a while. So as an outcome, the board then developed a fact sheet on the presentation of budget information. Now, the objective of a fact sheet is really to assist entities with the application of the principles in the standard. There's various questions, and then there's reference back to the principle in the standard and explaining to entities in a simplified manner how they should apply that. So specifically on the fact sheet around the presentation of budget information, there was questions around who should apply the standard. So when is the standard actually applicable to you? And one of the areas where there was concerns was around publicly available. So that's also one of the questions that's addressed in this fact sheet. What does publicly available mean? Then also, how should an entity present the budget statement? So what should be adjusted? Clarifying that you need to amend your actual amounts to be comparable to your budget and not the other way around. Also, a question around what is an approved budget? And how do you need to present? What is the format of the statement of budget that you need to present? So the fact sheet is available on our website. It doesn't have an effective date or anything to that extent. It is merely guidance to assist entities with the application of the standard. The next fact sheet around assessing going concern. So this fact sheet was developed as an outcome of the amendments to GRAP 1 dealing with going concern. So again, a number of questions and then how the standard needs to be applied in terms of that. So the first one is when should an entity prepare its financial statements on a going concern basis? So really, what is the standard saying? When should you prepare your financials on a going concern basis? At what point in time in this whole financial statement process should an entity actually assess if it still continue as a going concern? Also, a question around the time frame that the entity need to consider. So should an entity only consider on the next 12 months, or should we focus on a more medium to long term in order to assess whether there's uncertainties or whether the entity can continue being a going concern? And I think then also this fact sheet specifically on assessing going concern is including a number of events and conditions that management can use to help them in their assessment around going concern. And those are broken down into financial, into legislative, into operating, etc. So some of the issues that we've noted there on financial is, for example, to what extent is the entity relying on short-term funding to finance long-term assets? Or to what extent is the entity relying on long-term funding to operate the day-to-day expenses of the entity? To what extent is the entity able to meet its long-term and short-term obligations? From a revenue perspective, some of the indicators that could indicate that there's uncertainties is really when there's a reduction in the revenue, or there's intention of the National Treasury to ask the entities to surrender any of its surplus funding. Cash management, is there a decrease in access to cash? Is there, for example, a deterioration in the credit rating? So again, a number of indicators that I think is quite useful to entities and to management to assist them in assessing whether they can prepare their financials on a going concern, whether there are any uncertainties, and obviously then once the amendments to GRAP 1 has been effective, the disclosure of those uncertainties. Around the fact sheet, preparing the financials on a basis other than going concern. So the standards of GRAP do not provide guidance to entities when the financial statements are not prepared on a going concern. Standards of GRAP are based on the assumption that the entity is a going concern and will continue in the foreseeable future. But now when an entity concludes that it's no longer a going concern, what then? So this fact sheet is really saying, first of all, when should you consider preparing your financial statements on a basis other than a going concern? What are some of the recognition and measurement requirements that I should consider when I prepare financial statements on a basis other than going concern? If I still apply the standards of GRAP to develop accounting policies, can I still then say that I comply with the standards of GRAP? And then lastly, the exposure draft includes a number of disclosure items or disclosure information that entities could consider when they prepare their financial statements. So that really, in short, is where we are around the new information and what is available to the users. Some other resources and non-authoritative guidance, the frequently asked questions. So as and when issues are identified and there's a need for frequently asked questions, we develop frequently asked questions. The latest ones that we have added was around GRAP 103 and really just clarifying some of the application issues. I've talked about the fact sheets. I've talked about the review and the research report. So the first two are issued by the Secretariat, where the review and the research report, the results of the desktop review, are issued by the board. Then we have various presentations and recordings that's available on our website, on our YouTube channel. Also keeping in mind that there's a GRAP accounting guidance that's issued by the Office of the Accountant General. And again, as an outcome of a desktop review, we normally share the results with the OAG so that they can consider any additional implementation guidance that they could add to these guidelines. And then lastly, the GRAP disclosure checklist, which is also available on the website of the OAG. So that in short is what I wanted to share with you today around the new updates and the new information that is available. I'm just quickly going to run through the chat box to see if there's anything specific. I see that Elizno and Nabila has answered some of the questions, so thank you very much for that. I think I'm going to hand over now to Elizno to take us through the other issues, and then I will go through the chat box and answer the comments. Thanks, everyone.
Thank you very much, Amanda. Let me just get us back to the right slide from my side. What we are going to talk about next is the, sorry, let me just move all of you along. I'll just check that you're all with me when we get to the place that I want to start. You should now see slide 58, which starts with the overview of the exposure drafts that are available for comment. Okay, thank you. So I'll just start by giving you quickly an overview of the 4 exposure drafts that we have available for comment, and then I and my 2 colleagues will each take you through each of them in a little bit more detail. So firstly, I'll start by telling you a little bit more about Exposure Draft 200, which is the post-implementation review on GRAP 109, Accounting by Principals and Agents. We'll talk about the comment deadline there. Nabila will talk to you about ED 201, and alongside that, we've published ED 202, which is the improvements for this year, and an iGRAP that we're developing on foreign currency transactions and advanced consideration. And then lastly, Amanda will talk to you about an IPSASB concurrent exposure draft regarding leases and the public sector part of the leases project of the IPSASB. So let me start by giving you a bit of background on ED 200, the post-implementation review of GRAP 109 that we are doing. We do projects on our work program based on our stakeholders' input and feedback to us. And I think 109, although it hasn't been effective for very long, only since 1 April 2019, we heard from our stakeholders that this is a standard that entities struggle with to implement, and there are disagreements in the environment about how the standard should be applied. So the standard became effective in 2019 for all our entities that apply standards of GRAP, which is almost like unusually short for us to do a post-implementation review already. But I think the board decided that it is important to get this right. And if we can be a bit proactive with this project and provide guidance while entities are still trying to understand the requirements, then that may help everyone in the environment. So we do have or did have transitional provisions when the standard became effective on 1 April 2019. Entities were required to apply it retrospectively to all the arrangements that were still in progress at that date. So should you have had an agreement that was completed before 1 April 2019, even if it was in that comparative period for the first time year in which you applied the standard, you did not have to apply the standard to those arrangements. We, as well as the OAG, have issued guidance to help entities to apply the standard. So firstly, we do have a frequently asked question that sort of takes you through all the steps in GRAP 109 and explains to you how you should apply the standard. So definitely in the interim, while we're busy with the review and looking at the guidance that we could provide, please have a look at the frequently asked question. We also have some examples in the FAQ, and I think it will really help you to apply the requirements if you have any questions. Also, very recently, I think last year, the Office of the Accountant General put together a slide deck on principal agent arrangements, and available on their website is this presentation, which they've made available for anyone to use to assist in the application of the standard. So I think their presentation deals with it from both sides, the departmental side as well as the entity side on entities on GRAP. So it may also help you to understand a counterparty's perspective should you be in such arrangements, or an arrangement with the department and you're unsure about the nature of it. So the links are there for you on the slide, and you'd probably have to just access the slides on our website to click on those links. A post-implementation review is a very extensive project that we undertake to consult as many stakeholders as we can. We try and gather really any and all inputs about the standards, from our stakeholders. So it is quite an extensive project for us, with really three types of stakeholders from which we want to hear. Firstly, users of financial statements. We, of course, prepare financial statements for the users so that they get information that they need to make decisions about the entities that they have an interest in, and to keep those entities accountable for the resources that's been allocated and the mandate that they have. So it's very important in this review for us to make sure that a user is getting the information that they need about principal agent arrangements in the financial statements, and to understand what else they may need if they do not get what they need. From preparers, probably you're one of our most important groups of stakeholders to hear from. They are, of course, the group that need to understand the standard and prepare financial statements accordingly. So we do want to hear about all the challenges that preparers have to apply the requirements and to implement the requirements, so that we can see what next steps we can take. Auditors, of course, also have a lot of information that they can share with us about the difficulties that exist with the standard in the environment, and therefore we also want to hear from them about the issues that they're aware of. So just to share a little bit with you about the phases in which we undertake a post-implementation review, because it is such an extensive project. We started last year already with the first phase, where we aim to just get an initial understanding of all the issues that exist in the environment. We've completed that through mostly a desktop review. We have a look at the financial statements of a number of different entities to just see what they present and how they present it and what they disclose. Also with that, we look at the auditors' reports to see where issues may pop up. And then really the purpose of that is to prepare for the next phase of the project, which is the one that we are in now, where we consult our stakeholders. So a means of doing that is that we publish an exposure draft. So it's unlike our normal exposure drafts, where we are proposing changes to the standards or we're proposing new requirements. In this case, it's an invitation to participate in the post-implementation review. So what the exposure draft includes is background from the standard, and alongside that, we have posed specific questions to preparers of financial statements as well as to users of financial statements. And those are the areas where we would like the feedback to be focused. And it's based on the first phase where we've identified certain issues. So that informed the areas that we focus on in the exposure draft. But we also do welcome any other comment outside of those areas. So as per usual in our exposure drafts, there is a place for general feedback where you're welcome to share any other feedback that you may have. Then the outcome of this review is that our board will consider everything that we've heard from our stakeholders holistically to see what is it that we need to do to help preparers and users and auditors in the environment work with the standard. And there are a number of different things that could happen as an outcome. So firstly, there could be amendments to the standard. So GRAP 109 could be amended. So should that be the case, there will be a new project or a next phase to this project that will be a completely separate part of the project, where we will expose for public comment those changes to GRAP 109. Then another piece of guidance that we could develop is to develop an interpretation of the standard of GRAP, being then an interpretation that would be linked to GRAP 109. Again, that would follow the board's normal DU process. So as a separate project, we would expose a new iGRAP. You will then again, of course, get the opportunity to comment on that. Then us as the Secretariat could also issue non-authoritative guidance to help with the application. So we could issue frequently asked questions or revise the frequently asked question that we already have. And we could also issue fact sheets, which Amanda mentioned is not authoritative. So it has a status similar to the frequently asked questions. And that's been a sort of recent trend for us when we complete a project and we know more or less the areas in a standard where entities struggle. We prepare a fact sheet, we summarize all those areas on 1 or 2 pages for ease of reference. We can also, through this process, ask some of our other stakeholders to assist us with guidance. So we can reach out to the Office of the Accountant General and ask them to expand on the guidance that they have in the GRAP accounting guideline, as an example, or undertake other actions such as capacity building. So therefore, we don't want to limit the feedback that we get to just the requirements of the standard. If there are any practical challenges that you have, please feel free to share all of that with us. So I don't have a specific slide to deal with the specific areas that the ED focuses on, but maybe just to mention from what we've heard to date, certainly the area when it comes to GRAP 109 where entities struggle most is the first step that we would typically expect entities to apply, and that is to identify whether the arrangement that you have is a principal agent arrangement. In other words, to identify whether your arrangement meets the definition of a principal agent arrangement in GRAP 109. So I think particularly it's sometimes difficult to distinguish a principal agent arrangement from other types of arrangements. There are a number of misconceptions that we've heard of to date. Entities automatically think if there are 3 parties, then it's a principal agent arrangement. That's one misconception. Entities think it's only if all the parties are in the public sector that it can be a principal agent arrangement. So that's another misconception. It can be public sector and private sector entities. So there are a number of those that we can help clarify. Yeah, so I think definitely the important part in GRAP 109 is to know whether you are in or out of the standard. Once you know that you're in it, it's not so difficult to apply it. So we have published the ED 200, as I mentioned, on our website, so you can follow that link. And I mentioned that we have included the specific questions to preparers and users. So we do ask you to respond to those questions based on the experience that you have. If you're a preparer, then you probably would be able to answer all the preparers' questions. You may also have a bit of insight into what your users need, so you're welcome to share that with us. Users would, of course, respond to the users' questions. And then auditors, they may have experience to be able to respond to the questions we pose to preparers and users. So we do invite auditors to have a look at all the questions and respond according to their experience and the information that they have. So as an auditor, I think you, of course, understand the difficulties preparers may have. Maybe from your own interpretation of the standard, you can share with us where you think something is unclear. And you may also, from engagements with oversight structures, have some insight into what users would need. So the comment period closes 15 September 2023. We do plan on having multiple stakeholder engagements from now until then, so that we can gather as much comment as we can. On the website with the link that I had just shared with you, we have published some supporting material. So there is an executive summary that just helps you to understand all the requirements from the standard. And we've also made a presentation available on our website. And I think from yesterday or the day before, we now have a presentation that's been recorded. So there's a recording as well available on that link on our website. So that will take you through all of the background that's included in the ED, as well as the questions that we have. I think the presentation is about 45 minutes or just short of 50 minutes. So yeah, just so you have an idea about what to expect. The ways in which you can participate in this review is you can submit written comment to us. We always appreciate the time our stakeholders take to write to us. I think that's a really good way of expressing the issues that you may have. And if you want to, for example, submit us one letter from an organization, you can gather input from all the people within your organization that may want to share information with us and submit it to us that way. So the questionnaires that we have on the website pose the questions to preparers and users in separate questionnaires, and you may use that as a means of responding to us on our email address info@asb.co.za. But if you would like to submit us comment in a different form in writing, that's also welcome. You can even just send us an email if you don't want to respond to all the questions and you maybe have a specific issue and you only want to share that, then that may be an easier way for you to communicate with us. Also on our email address, info@ASB, or any kind of letter that you want to send to us is welcome. Did I mention the stakeholder engagements that we'll be having? We've started with those already. So for the next couple of months until September, we have a series of events and roundtable discussions planned. We'll work through the exposure draft. You can contact us on info@ASB if you want to make sure that you'll be invited. If you are interested in this, please do let us know. Then we can just double check and make sure that we do invite you. You can also send me an email directly, listener@asb.co.za. I'll maybe just share with you my email in the chat. Yeah, then it may just be a quicker way of getting invited than sending it to the info@ASB address. Okay, that is what I wanted to share with you on ED 200. I just want to see if you have any questions. Okay, it doesn't look like it. So I'm handing over to Nabila then for the improvements. Thank you.
Thanks, Lesna. Okay, please let me know when you can see my screen. It should say ED 201. Okay. Thank you. Okay, so before I go into ED 201 and ED 202, I just want to let you all know that today I'm just really doing a high-level overview of the proposed amendments. So please don't worry or freak out that whatever you are seeing on the slides and what I'm saying is well, what I'm saying is way more than what's on the slides. We do have roundtable discussions coming up where these discussions will be way longer, and then I will take you guys by the hand and discuss these amendments, these proposed amendments in detail. So just to give you an idea of where in the process we are with ED 201 and ED 202. So at this point, the EDs have been approved by the board. They were approved in December last year. So we are at a point now where we are scheduling our roundtable discussions. The first one is on the 22nd of February. The roundtable discussions are to mainly get your verbal comment, and then obviously you can also submit any written comment. Okay. So now on ED 201, just a little bit of background in how we went about developing the exposure draft. So we firstly looked at amendments to IPSIS as part of the 2019 and 2021 improvements to IPSIS. We also looked at amendments to IFRS standards as part of their improvements to IFRS standards, in particular the 2018 to 2020 cycle. And then we also looked at other IFRS narrow scope amendments. We also considered general improvements, which we derived from our consultation with stakeholders. So looking at all of this, we then identified where we would need to make amendments to the standards of GRAP. Right, so I'm just going to go at a very high level through some of the proposed amendments that we are going to look at in the improvements project. Right. So the first one I want to discuss is on GRAP 1, presentation of financial statements. Just for you to note that the proposed amendments made in the improvements ED is to the standard of GRAP that will be effective 1 April 2023. Yeah, so that's the new one that's going to come into effect. So the change we are proposing here is on the disclosure of accounting policies. So when GRAP 1, we require disclosure of significant accounting policies. We've just changed that to material accounting policies. And this is because the standards of GRAP do not define the term significant, whereas the word material is well understood by users and it is also defined. Next up, you can see there's a list of standards, and the standards are GRAP 1, GRAP 2, GRAP 13, GRAP 19, GRAP 23, GRAP 27, GRAP 31, and GRAP 104. So what we've done with these standards is that we've identified encouraged disclosure. And then we've assessed whether these encouraged disclosures are actually providing useful information. Where we found that these disclosures have limited information value, we are proposing to remove them from the standards. The next standard is GRAP 3 on accounting policies, changes in accounting estimates and errors. Here we have two proposed amendments. The first one is a proposal to change the definition of an accounting estimate. And here we found that the previous definition was not sufficiently clear. It also just didn't define the term accounting estimate, but rather defined what a change in accounting estimate is, which is a little consistent to how an accounting policy, for instance, is defined. And here we find that stakeholders somewhat experienced confusion in when do you have a change in accounting policy versus a change in estimate. And we thought by changing this definition, it could clear a lot of the confusion. The next one is a small amendment, and that's just to clarify that the requirements in GRAP 3 to disclose standards issued but not yet effective only apply to standards of GRAP that are not yet effective, for which the Minister of Finance has already determined an effective date. This is already in an FAQ, but we thought it may be more useful to actually bring it into the standard. The next one is the addition of illustrative examples. So we've now included illustrative examples in GRAP 5 and GRAP 24. And in GRAP 5, the illustrative examples we included were actually adapted from IPSIS 5 on borrowing costs. These illustrative examples just illustrate how an entity can go about calculating borrowing costs, and they discuss about 4 scenarios. The other standard we added illustrative examples to is GRAP 24, and these examples just basically show stakeholders how presentation and disclosure requirements can look when applying GRAP 24. Moving on to GRAP 17, the amendments we propose here are made to prohibit an entity from deducting proceeds from selling items produced before that asset is available to be deducted from the cost of PPE. So these items where the entity would receive proceeds usually come from when the item is being tested and samples are produced, and that actual sale or the sale of that item is then deducted from the cost of PPE. So now amendments are made to actually prohibit that. There are also minor amendments made to standards like GRAP 20 there, which is listed, GRAP 31, and also the guideline on materiality. These amendments are minor and they are just made to ensure consistency and clarity between the standards of GRAP. If I look at GRAP 20, for instance, the amendment made there is to the definition of significant influence, and it doesn't change the principle at all. It just aligns the wording to read 100% to the wording that we use in GRAP 36, which is investments in associates and joint ventures. Moving on to GRAP 24, presentation of budget information in financial statements. So here we have 2 amendments that we are proposing. The first one is to provide more clarity to the terms publicly available and publicly accountable. What we found here is that stakeholders experience difficulty in determining and assessing when GRAP 24 is applicable to them and when they actually have to apply it. So what we've done is that we've provided more of an explanation on what publicly available is as well as publicly accountable. We've also tried with another amendment to simplify the disclosures on the presentation of a reconciliation. So this is the reconciliation of actual amounts on a comparable basis and actual amounts in the financial statements. So we've done this to improve the quality of reporting by not prescribing the line items to reconcile to. So the standard before the proposed amendments actually prescribes the line items that an entity should reconcile to whether the budget is prepared on an accrual basis or another basis. So now the amendment just removes the line items prescribing an entity to reconcile to these specific line items, but now just actually leaves it up to the entity to decide themselves which line items they would like to reconcile to based on the entity's judgment by providing the best information or fair presentation of the reconciliation. Okay, the next standard we made amendments to is GRAP 104, financial instruments. So with this one here, it is the new standard of financial instruments. So the one that's not yet effective, but will be effective on 1 April 2025. So we've made amendments to that GRAP 104 and not the current one. This is because the likelihood of this improvements ED becoming effective while the current GRAP 104 is still in effect is probably not going to be the same. So this improvements project and this ED, we're looking at an effective date of 1 April 2024. And at that point, the current GRAP 104 will no longer be effective. So the first amendment we proposing in GRAP 104 is based around the interest rate benchmark reform. And this is just to accommodate the change in the benchmark interest rate. So where we have now the South African Reserve Bank looking to replace JIBAR with Saronia, and that potential effect on cash flows of a financial instrument. So the amendments we propose is to provide a practical expedient, not to treat those changes in contractual cash flows as a modification. Also, another amendment we're proposing that we also adopted from IPSAS is to clarify the fees that an entity includes when it applies the 10% test to derecognize a financial liability. So the amendment here just includes the types of fees that an entity should consider when it applies the 10% derecognition test. Right at the end of ED 201, we have an extra A, and an extra A just basically deals with minor editorials to the standards of GRAP, which is basically the GRAP handbook. Okay, so that covers ED 201. Looking now at ED 202. So ED 202 is an interpretation to the standards of GRAP, and it deals with foreign currency transactions and advance consideration. So we decided to develop this interpretation, and this was just based on monitoring conversion with the ISB. So the ISB already has an interpretation with regards to this, and this is IFRIC 22. IFRIC 22 just clarifies which exchange rate to use in transactions that involve advance consideration paid or received in a foreign currency. Just to explain the consensus quickly, it's that where an entity, for instance, has a prepaid expense in foreign currency, entities were just wondering that once the prepaid expense is released to either an asset or an expense, what exchange rate should be used. So the interpretation clarifies that the exchange rate to be used is the exchange rate that was used when, for instance, the prepaid expense was initially recognized. And so minor adaptations were made to IFRIC 22, nothing major at all. And this was just mainly aligning the terminology in the IFRIC to the terminology we use in our local standards. For example, where the IFRIC would refer to income, in the standards of GRAP, we do not have the income concept, we refer to revenue. Okay, so in terms of ED 201 and 202, this is how you can have your say. We have roundtable discussions scheduled in February and March. The first one is to kick off on 22nd of February. So please do attend those discussions where I will be discussing the amendments in detail. And we also appreciate any comment we receive in those discussions. The invitation to comment is available on the ASB website. You know that you can also comment in writing. The comment period closes on 28th April 2023. Thank you, everyone. That is my bit on ED 201 and ED 202. I'm going to hand over to Amanda now.
Thanks, Nabila. Can everybody see my slides? Right. Okay, so I'm quickly going to talk about ED 203. So this is the concurrent IPSAS exposure on concessionary release and right of use assets in kind. So first of all, to say that the leases project is a two-phase project at the IPSAS-B. The first phase being the approval of IPSAS 43, which is aligned with IFRS 16 on leases. And the second phase of the project really involves looking at public sector specific leases issues, which includes concessionary leases and right of use assets. IPSAS 43 has an effective date of the 1st of January 2025, and the intention for the IPSAS B is to complete the second phase of the project by that time, so that IPSAS 43 includes the guidance similar to IFRS 16, but then also to include the specific public sector leasing issues. So ED 203 is really exposing the second phase of the IPSAS B's project and guidance that's specifically dealing with public sector leases, concessionary leases, and right of use assets in kind. The comment for us locally is closing on the 6th of April, which is a bit earlier than the IPSAS B, but that is really for us to collate all the comments and finalize the comment letter that we need to send to the IPSAS B by the 17th of May. We have arranged various stakeholder engagement. So again, as with the previous one, not going to go through all the detail, but just highlighting some of the principles in ED 203 so that you can start thinking about them. Again, if you are interested in attending the discussions that we want to arrange, please just send your email information to me and I'll make sure that I include you as part of the invite. So really what 203 is saying about concessionary leases, first of all, it's not defining a concessionary lease, but it does provide a description of a concessionary lease. A concessionary lease is a lease at below market terms that has an exchange and a non-exchange component. The guidance from a lessee's perspective as to how you need to account for the liability and how you need to account for the asset is first of all to measure the liability as the present value of the contractual lease payments. In measuring the liability, you need to apply a discount rate to those lease payments, which is the interest rate implicit to the lease, if that is readily available. If it is not readily available, you apply the incremental borrowing rate in order to measure your liability. The right of use asset, so that's the debit part, you measure as the present value of the payments for a lease at market rate. The difference between the liability and the right of use asset is the concessionary component. And in terms of the proposals, you need to recognize the concessionary component immediately as revenue unless there are any present obligations. So that's applying the principles in GRAP 23, or IPSAS 23, pardon me. So to the extent that you have an obligation, you will firstly recognize the liability. And as and when you recognize the present obligation has been met, you will decrease your liability and recognize your revenue. From the guidance on the lessor side is really to say that they need to apply the guidance in IPSAS 43. So for a finance lease, if the lessor enters into a finance lease, the transfer of the underlying asset is measured at the carrying amount. And the concessionary component in a finance lease is really the difference between the carrying amount of the underlying asset and the newly recognized net investment. From an operating perspective, the lessor needs to recognize the lease payments as revenue, either on a straight line basis or on another systematic basis if that is more representative. Again, the operating lease concession is the difference between the revenue, the lease payments that is recognized, and the expenses for the underlying asset. Then the next area that ED 203 is dealing with is a right of use asset in kind, and specifically providing guidance to a lessee. Again, there's not a definition for a right of use asset in kind, but merely an explanation. So this involves an arrangement that conveys the right to use an underlying asset, but there's zero consideration. So there's no lease payments that is paid in this arrangement. And looking at the definition of a lease, it's not really meeting the definition of a lease because there is no consideration. And therefore, guidance has been included when the lessee is involved in a right of use asset in kind. The proposed accounting, the proposal is to say that it is similar to a concessionary lease. So again, looking at the guidance that I've just explained, you apply the same principle if you have a right of use asset in kind. Asset in kind is measured at the present value of the payments for the lease at market terms, if there are any payments. And again, the concessionary component is the difference between the liability and the right of use asset. Remember, you recognize an asset if you are involved in a finance lease. So again, the concessionary component is recognized immediately as revenue in terms of IPSAS 23, unless there is a condition. In that case, you will firstly recognize the liability, and as and when the conditions are met, you will then recognize the revenue. In addition to the disclosures that have been included for concessionary leases and right-of-use assets in kind, there's also amendments to IPSAS 23 around the disclosures. And these include disclosures around the nature and the type of major classes of right-of-use assets, the information around the depreciation, and the carrying amount at the end of the reporting period by class of underlying asset. In addition, IPSAS 23 is also indicating that you need to consider the disclosures in IPSAS 16 on investment property, on property, plant and equipment. And that really in short is what ED 203 is about. Like I've said, we are arranging engagements in April. The comment is closing on the 6th of April. So really not that much time if you want to comment on the international proposals, but really there's sufficient time for us then to collate all the comments and then send the comment letter through to the IPSASB. So with that, I'm handing back to Elizna to take us through the last section of today.
Thank you very much, Amanda. Yeah, I'm just waiting for the slides to load. Okay. So I think we've spoken a little bit earlier today about why it is that we look at IPSASB pronouncements and the board's policy that it has to converge with IPSAS. We are involved in the work of the IPSASB because of that policy, and we do, as part of converging, assess our mandate and our strategy to determine what's appropriate for us to align with. The more we can provide comments and input to the IPSASB while they are still developing the pronouncements, the better. That's also, as Amanda just discussed with you, ED 203, why we gather your comment and submit comment letters to them. So we thought it would be good to just end today's session maybe on a lighter note and share with you a little bit about what the IPSASB is busy with, so that you know what's coming in the environment and what we may be looking to do next. So I think we've spoken about a number of their projects already today, but we've categorized them sort of by the stage that they are in. And let's start with some of the pronouncements that they have approved recently. These are not yet effective and therefore not yet included in any of our communication. So firstly, IPSAS 43 on leases. Amanda spoke to you now about the second phase of the leases project, where they're looking at the public sector specific side of things and making amendments to this. They have the effective date of 1 January 2025 for this IPSAS, and it does converge with IFRS 16 on leases. So it is a change in the model for lessors compared to the previous IPSAS 13 on leases. And we, as standards of GRAP, have alignment to the previous version of IPSAS. So we in GRAP 13 still use the model prior to what they have in IPSAS 43. So it would require from us to consult with you quite a bit before we consider making any changes to GRAP 13. And we would unlikely be able to do that within our next work program. Then IPSAS 44 on non-current assets held for sale and discontinued operations. So as part of the measurement project that the IPSASB is undertaking, they identified a gap in their literature that they don't have an equivalent of, is it IFRS 5 on non-current assets held for sale and discontinued operations. So they decided to incorporate this as part of their measurement project to develop an IPSAS, and they could do that fairly quickly and almost in isolation of the rest of the work they're doing in the measurement project. This was then the first finalized product from that project, which they published with an effective date of 1 January 2025. So as you may know, we have GRAP 100 on non-current assets held for sale and discontinued operations. So we actually previously included a lot of the guidance that would be in this IPSAS, but based on the usefulness of the information to our users in the local environment, we changed GRAP 100 quite a long while ago, a couple of years ago already, to do away with some of the non-current assets held for sale requirements that were simply not providing useful information to users. I think, the requirements are that you need to dispose of those assets within a year in order to classify them as such. And because of a legislative process that entities need to go through, that just often doesn't work in practice. So our requirements in GRAP 100 focus on discontinued operations, but we do have some disclosures in GRAP 1 that you need to consider in addition to GRAP 100 now. So we are unlikely to do anything in our environment. We may just circle back and test whether what we've done previously still makes sense now that IPSAS 44 has been issued. Then improvement to IPSAS 2021, they've issued that, I think, in 2021 with the effective date of 1 January 2023, but the IBOR changes are applicable from 1 January 2022, just because of the urgency of those. The improvements that we're talking about here was all considered as part of the improvements project that Nabila had just quickly discussed with you, ED 201. So any changes I made here, we did consider whether we need to make those changes to the standards of GRAP in ED 201. Of course, it's now out for comment, so you can let us know whether you think it's appropriate or not to make those changes. Then the conceptual framework limited scope update phase 1 on measurement. That is the second part after IPSAS 44 of the IPSAS-B's measurement project that they've now completed and finalized. So the board did approve, the IPSAS-B board now. When I say board, I mean IPSAS-B. They did approve these changes to their framework at their December meeting. And the conceptual framework, of course, does not have an effective date. So when they publish that, then it would be available for use. So the main changes that they've made to their framework, the measurement chapter, is to bring in the revised definition of fair value as is in IFRS 13, as well as the new public sector specific measurement basis, current operational value. They developed that from scratch with help of their stakeholders, and the idea is that it is a current value measurement basis that you can use when you have assets that are used for operational capacity instead of held for their financial capacity. So of course, fair value works when it's financial capacity, but not so well when it's operational capacity. Therefore, there are some nuances that they brought into the current operational value measurement basis that will work with current with operational capacity assets. There is also something else that they recently looked at that sort of ties in with the conceptual framework, and that's the initial measurement of items in the financial statement. So they have a measurement hierarchy now in the conceptual framework that sets out the measurement models first, then measurement bases, and underneath the measurement bases, you would have measurement techniques that you use to calculate those measurement bases. The techniques are dealt with further at standards level, but the measurement hierarchy applies to subsequent measurement. So on initial measurement, they agreed that all items are initially measured at transaction price plus transaction cost, and then there are circumstances when that may be inappropriate or it will not be doable because of the information that you have or don't have, and therefore you may look to deemed cost as another way of initially measuring, but that is also dealt with further at standards level. Then IPSAS on property, plants and equipment. This is the third pronouncement from the measurement project that they had finalized, and that was also approved at the December meeting. But they are going to align that with the IPSAS on measurement, which they are still working on, to know when that will be effective. So the IPSAS on property, plant and equipment actually had sort of three streams of input to make changes to this IPSAS. And the first one was the measurement of property, plant and equipment, which is why it's linked to the measurement project. So what they have done is to incorporate the new measurement basis for assets held for current service capacity, to include that as an option to subsequently measure your property, plant and equipment. So if you are on the cost model, then you still apply the cost model as you had before. But if you are on the current value model, you would now have to apply either fair value or current operational value to those assets held for operational capacity. So you would need to make an assessment about why you are holding the assets. Is it financial capacity or operational capacity, and apply fair value or current operational value accordingly. So that alongside the initial measurement at deemed cost is the other change from the measurement project that had come into the IPSAS on property, plant and equipment. So you will know in the PPE standard, if you, for example, initially receive an item of property, plant and equipment in a non-exchange transaction, the guidance said that you are going to initially measure that at fair value. Now you could get in a non-exchange transaction an asset that you are going to use for a service potential and hold for operational capacity. And in those circumstances, it may be appropriate to use current operational value. The other two streams that fed into the ED on property, plant and equipment, which now resulted in this revised IPSAS being approved, was guidance on heritage assets and on infrastructure assets. So mostly it resulted in non-authoritative guidance to this IPSAS, where they explain how you would apply the existing principles in the standard to infrastructure assets and to heritage assets respectively. And there are some circumstances where you would now apply provide additional information, especially on heritage assets, as a result of the amendments that they've now made. So as an example, if you are unable to measure an item of heritage assets reliably, and therefore you don't recognize that piece of heritage asset, you are going to have to provide additional information now on those assets that you haven't recognized. So that's it on the IPSAS on PP&E. It will likely be a replacement of IPSAS 17. So like we saw with the IPSAS 25 on employee benefits that they reissued as IPSAS 39, they may go ahead and renumber this. Instead of IPSAS 17, it will be something else. So the next part is the consultations that are in progress. So you know about ED 84. Amanda spoke to you about that now. I'm not going to say anything more about that. Then just completed consultations and the projects that are still in progress. You may recall us consulting you last year on ED 81, where the IPSASB proposed a second phase of changes to their conceptual framework, qualitative characteristics and elements in the financial statement. So that included new definitions for assets and liabilities, guidance added on things like unit of account. So all of those changes, the IPSASB is now busy working through all the comments they had received and as a next step, they will decide how they would like to finalize the guidance in their conceptual framework. So that is still very much ongoing. Then another exposure draft they issued was on retirement benefit plans. We did not consult our stakeholders on this locally simply because of the limited application of this to our local environment. If that's something you are interested to know about, they are busy considering the feedback that they had received on this exposure draft. So also still very much in progress. The next part is you may know of a number of recent consultations I had undertaken on sustainability reporting. So I thought I'd just put all of that together for you on one slide. So they've issued a consultation paper on natural resources alongside their consultation on advancing public sector sustainability reporting. So the consultation paper on the sustainability reporting considered what is it or what could it be in the public sector? Is it needed in the public sector? Who should provide guidance on this in the public sector, and what should that focus on? So based on the responses that they had received to the consultation paper at the December meeting, the ASB decided to commence work now to scope the 3 potential public sector specific sustainability public sector specific sustainability reporting projects. And they have sort of caveated that with funding. If they are unable to secure sufficient funding, then they are likely not going to be able to proceed with these projects. So they have asked their stakeholders to support them and provide them with the resources that they need to continue these projects. But the first phase would be for them to scope the projects that they may be able to undertake. They will also establish a sustainability task force that would lead the first phase of the research and the scoping of the 3 projects that they could undertake. So the prioritized research topics are firstly general requirements for disclosure of sustainability-related financial information. Secondly, climate-related disclosures, and thirdly, natural resources. So this is where the CP on natural resources that was issued alongside the CP on sustainability reporting features in. So on natural resources, it would be about non-financial disclosures, and they would consider this in parallel with the development of financial reporting disclosures from the CP on natural resources. Then exposure draft 83 on reporting sustainability program information. They proposed non-authoritative amendments to their 2 RPGs, 1 and 3. So the RPGs in themselves are non-authoritative, which means it is non-authoritative. And they've issued this in November last year with a comment period that closed mid-January. So we didn't issue this concurrently as an exposure draft, but we did talk to our stakeholders about the proposals and sent comment to the ASB on this. So what they had developed was to propose how these existing RPGs with slight amendments to the RPGs applies to sustainability reporting, just to highlight that to their constituents. So they are now considering the feedback that they had gotten back on the exposure draft. It is non-authoritative implementation guidance and illustrative examples that clarify the application of the key programs based on these RPGs. So yeah, the current phase there is that they are considering the comments, and they will discuss how this can help shape the work that they are going to do on sustainability reporting. I think some of the key comments that we had submitted was we would like to see holistically what the plan from the ASB side is to provide guidance in this area, and that it's important to ensure that any guidance that they issue now will work with what they plan to do in future. Okay, so then just as a last slide, there are other projects that you would have heard us talk about already that's in progress at the ASB. Revenue and transfer expenses, both, of course, very long-standing and extensive projects, sort of groundbreaking in a way, because they are looking to develop new models for the public sector, but also an element of alignment with private sector IFRS 15 requirements. So they have finalized the discussions on the core principles of revenue and transfer expenses, and they're now working through non-authoritative guidance, looking at illustrative examples and implementation guidance and what they should be issuing there. The basis for conclusions was considered by the board for the first time in December. So yeah, I think they are mostly there to decide whether or not to re-expose, and they'll look at that at the March meeting. So hopefully around that time we will know whether we can expect revised exposure drafts or whether they are going to issue finalized standards. Should they re-expose these principles in new exposure drafts, we will certainly issue them concurrently as local exposure drafts, and you can expect to hear from us about engagements on those proposals. Then on measurement, we spoke about a number of elements of the measurement project that have recently been finalized. So what remains is the IPSAS on measurement, which will provide standard level guidance aligned to what was issued by the ASB as IFRS 13, but broader than that, because it would include guidance on other measurement bases and not just on fair value. It would include current operational value, historical cost, etc. On the liability side, cost of fulfillment as well. So the key discussion at the December meeting focused on deemed cost and how that should be interpreted and applied across the various suite of standards. They did decide to follow an approach similar to what they had done with other concepts, that in the measurement standard, the principle will be included. So it would say that initially transactions are measured at transaction cost plus transaction price, and then there may be circumstances where you would use deemed cost if that is inappropriate or not available. Then other standards of IPSAS would provide you the detailed guidance based on the transactions and events that those standards deal with, to say what are the circumstances when deemed cost would apply and what deemed cost would be in those circumstances. So you would need to read this IPSAS on measurement with the other standards to know what you should apply. Then the application of current operational value will be considered by the IPSASB in a newly added second phase to the measurement project. So far, they've only considered its applicability to property, plant and equipment as part of revising the IPSAS on property, plant and equipment. In this next phase, they will then evaluate the application of COV for other IPSAS where they haven't yet explicitly considered this as part of the first phase. So they will commence the second phase after they finalize the IPSAS on measurement in March. So from April onwards, they will start that second phase. The presentation of financial statements is a project that was added from the mid-period work program consultation. They are looking at revising the way in which information is presented in the financial statements, and that stems from work that the private sector is doing, the ASB. So they discussed at the last meeting the research that's been undertaken to understand what other standard setters are doing and what possible ways the public sector could look at presenting information in financial statements. So now they're just looking at research, and they're performing some scoping activities so that they can finalize the project brief. There is a lot of work that would need to go into that before they can pin down the project brief. They also discussed this with other standard setters last year at the International Public Sector Standard Setters Forum, and got good inputs into what this project needs to consider. So they also want to bring that into their scoping activities to finalize the project brief. They do expect the project brief to be approved this year. And then the last project on differential reporting, it's another project that they added based on the mid-period work program consultation. So they are researching what international guidance exists, and they're trying to understand the issues that exist, what this project needs to address. So I think we have some experience locally in trying to understand the issues that exist with smaller entities and how we could address that. And I must say that I have some sympathies for them, because trying to do that in an international environment must be quite difficult. Of course, each jurisdiction would have its own challenges and its own reasons for needing and wanting differential reporting. But that is all part of what they are looking at now as part of developing the project brief. So that is the last slide that I wanted to share with you. I just want to see if you have any questions. I don't see anything in the chat, so I think you are covered. Also don't see any hands. So then, just to end off today's session, we thought we'd just share with you ways in which you can stay informed of the work that we are busy with, and things that we publish and working on. So firstly, we do have all the information you may be looking for available on our website. That is where we center everything that we do. So please have a look at our website. The frequently asked questions that we issue, you will find under standards of GRAP on our website. We publish the FAQs there underneath the standards part of the website. Then please follow us on our various social media platforms. We are very active on LinkedIn, Facebook, Twitter, as well as now on our YouTube channel. So we post regularly on the articles, bits of information about projects and what you can be involved in. And we also just try and share anything that we think is topical with you in the broader public sector reporting environment. Then our newsletter is another way in which we do all of those things that we do on social media. That's a great way for you to be informed of what it is that's going on. So you can subscribe to our newsletter via our website, but you can also send us an email on info@ASB if you struggle in any way to subscribe. And then I think just lastly to note that we do translate the standards of GRAP, and the English version is the official version, but other translations are available on our website as well. And then just to mention again that the updates that we have provided to you today will be available on our YouTube channel as a recording probably in the next week. And I would just like to keep this slide on for a moment or two in case you would like to get any of our contact details. So with that, I think we are right on time as we've scheduled the session for today. Thank you very much to all of you for listening to us today and for participating. We always enjoy the questions that you ask, and if there's anything else that you think of afterwards, you're welcome to send us an email, and we can see how we can help you with that. So we really appreciate you listening, and have a wonderful weekend. It's nice to end on a Friday, I think, with this. So I do just see one question about an attendance register. There's no attendance register that we keep, but you're welcome to share with us if you have any need for us to confirm that you did attend today. Then I think we can do that. So I just want to hear if Amanda or Nabila would like to say a last few words, and I think then we can close the session.
Thanks, Elisna. Nothing from me. I'd just like to thank everyone for joining and for them to have a lovely Friday and a good weekend. Thank you, everyone.
Touche. Okay. Wonderful. Thank you, everyone. I think with that, we can close the session then and have a wonderful weekend further.